You are listening to Keystone's Stock Talk Show, episode 285.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. I will kick off the show highlighting the tremendously strong Q3 fiscal year 2025 numbers from Aritzia, symbol ATZ on the TSX, a company which should be no stranger to clients. It's been in our focus buy in our Canadian small cap portfolio since 2020. The fashion retailer shares are up 110% over the past year, crushing the likes of Lululemon and Canada Goose in the Canadian retail landscape. We look at what is driving the growth. Aaron looks at the headline news of the week, with big US tech plunging on Monday following the news of a Chinese AI competitor. NVDA's shares were down 17% on the day alone. Aaron lets you know if there are opportunities or if Monday's rout may continue. In our Your Stock Our Take segment, Brett answers a viewer question on Dirtt Environmental Solutions, symbol DRT, on the TSX, a modular interior construction company that specializes in sustainable building solutions. While the company's shares are up significantly over the past year, the long-term share performance has been poor. Brett lets you know if what is driving the rebound and if it can continue. Last and definitely not least, Brennan answers a viewer question on ADF Group, symbol DRX on the TSX, a North American leader in the design and engineering of connections, fabrication, including the application of industrial coatings and installation of complex steel structures, heavy steel built-ups, as well as miscellaneous and architectural metals for the non-residential infrastructure sector. The stock is down well over 50% from its 2024 highs. After authoring a monitor report on the stock for our clients, Brennan lets you know his take on the business. All right, gentlemen, how was your weekend, and are you ready? We got a huge conference coming up, the World Outlook, in a couple of weeks. These two guys will be in Vancouver. Aaron will walk across the street and go to the event, basically, right? And we should have a good time. Should have at least, a couple 100, 400, 500 of our clients at the event. Be great to sit down and chat with you there. So if you're not going, go to the Outlook's website, get some tickets. We'd be happy to sit down with you. Smile, shake some hands, smile at some babies, kiss babies, whatever you do at these events.
And if you can't make it to Vancouver, I think they also have an online auction or videos afterwards.
Myself and Aaron will be speaking at the event. We love doing it. We usually close out the event. They hold us at the end because we know it's just so everybody stays right to the end, right?
Apparently, that's what we've been told.
Yeah. We've been told that. We thought it sounds like we're making it up, but apparently we've been told that. So it's good to hear that people want to hear us there. We're not sure why, but we try to provide some good companies. But we'll have a few picks at that event as well. Again, all of our clients
on where the market
have those recommendations.
Sorry, go ahead, Ryan.
Well, I was going to say they're not going to be new recommendations. They're recommendations that we have in our research already.
Yeah, there's going to be a few companies
in addition
there.
To recommendations, we're also going to just be looking at what's going on in the economy and the markets right now. And this is a good opportunity to really assess everything as we enter into the year. We'll be about a month and a bit into the year at that point, but we'll have a good sense really of kind of what direction maybe the trade issues with the United States are going, what other global issues where they're trending. So we'll talk about that, and most importantly, how that is applicable to making good investment decisions.
Yeah, it's an incredibly interesting time right now in the markets. Although, having said that, there doesn't seem to be any dead periods anymore. There's always something on the outlook or dropped on a daily basis. And Aaron's going to talk about one of those today that just dropped today. But first, we've got a poll question. it's about tariffs, right? Or
Yes.
Brennan, did you have something to say? I think
I did have something
Just
to
tell
say.
us what you had to say, young
I was
man.
just going to say there's, again, going to be, about 5 companies that we have under coverage that are going to be at the World Outlook, giving presentations as well. Again, these are all known to clients already, like Ryan was saying, these companies that are going to be there, but they will be making presentations there as well. So it will be nice to sit in those presentations and ask some questions as well to management and shake some hands.
Yeah, for sure. All right, let's get to that poll question. What impact do you believe tariffs have on your portfolio in 2025? Positive, no significant impact, or negative impact? What ruled the day? What answer?
So, yeah, surprisingly, or unsurprisingly, I would say, is negative was the biggest share at 46%. No significant impact at 37%. Then positive 17% believe there's going to be a positive impact. And I think one of us here said that.
Which
Yes.
is
So
interesting.
take us through that.
First thing I thought was, of course, I knew that the negatives were going to win, but I thought they would win by a much larger margin. So I was going to ask the question. I was going to say, I wish I could ask the question to somebody who picked positive for their portfolio. And here I will have the opportunity. So Brennan's going to explain his rationale.
I think on the no, negative, and positive, on the no negative, it might be people just saying there won't be tariffs. I think that's maybe what they're thinking, but yeah, I'm just guessing there. But go, Brennan.
Yeah. So, first off, obviously, who knows what will happen? No one knows. But yeah, so I voted that it will benefit my portfolio. But the reason for this is that I have a decent exposure to like an international manufacturing company, which currently has like a free trade agreement with the US. And we recently spoke with the company last week, and kind of the thought here when we asked them about it is that Trump is being fierce with potential tariffs on other countries, other than the one which this business operates in, which may force, like Chinese companies, as an example, to kind of contract manufacture with this other company, which I'm referencing. Now, like, again, the caveat is that Trump could impact the country's free trade agreement in which this company actually does operate within. But, they are an important U.S. ally in a riskier region of the world. So I presume the free trade agreement will, stay as is, but obviously anything can happen. But that is why I voted that way.
And is this the only company in your portfolio?
No, but I do have some good exposure to it. I will say, like,
Okay.
it's yes. So
okay, I'm just wondering because for that to, for a macroeconomic event to be positive or negative for your entire portfolio, I mean, unless this is, most of your portfolio, it might not.
Well, it's 95.9% of my portfolio.
Well then, yeah, for sure. Yeah,
I'm joking. I'm joking.
I
No.
See
It's
a good
under.
point there, and it's good because as you were making your point, I thought of another point why I could have answered yes to that question as well. That I think it could be positive for my portfolio, but because really, the country that this company operates in is kind of really not on the radar, and as you said, is an important ally in a precarious region. So as long as they stay off the radar, then there might not be any reason. And all the companies or countries that are on Trump's radar, if they have to deal with tariffs, then it would be a net benefit. So and definitely, and I think it's important as well to think in this way, like, what are some companies? Not that you would want every company in your portfolio to be in this situation, but what are some companies that actually stand to benefit from those?
Yeah, and I just want to again say I was joking about it being 95% of my portfolio. It's probably 5%, if not even a little bit lower. So again, Aaron brings up
yes,
a
of
good
course,
point because
and anybody who knows Brennan would know that, but it's good that you're clarifying because not everybody watching the show knows you.
Yeah, exactly.
Most
I'm gonna actually
around
make
the
my
world,
point.
But
sorry.
Nothing. Most do know Brennan around the world, but let's be honest.
I'm going to make my point, actually, why I could have, I actually answered that it would be negative for my portfolio, but I'm actually going to make a counterpoint of why it could actually be positive. And it's going to be based on a few assumptions. And the main assumption is that things are going to get worse before they get better. But ultimately, where things are going to end up is very much where they ended up the last time we negotiated this agreement, where there weren't any major obvious changes that had a huge economic impact, at least in the short term. Some people can argue about longer term, but that's another thing. Basically, that if these trade tariffs are erected, then eventually they will be removed and something will be negotiated. But what will happen in the interim is that there will be a lot of volatility in the markets, and that can be a very powerful period of time for somebody who's an individual stock picker if you know how to pick stocks, particularly if cooler heads do eventually prevail and things normalize. I remember, this is aging me, but back during periods like post financial crisis where there was the European debt crises, there was all these different crises that seemed to be popping up in the few years after that, around like 2011, where the market was just going up and down like a seesaw. And what that really did is it opened up opportunities where really great companies were on sale, or at least a lot cheaper than they were back then on sale, in spite of the fact that there was likely not going to be a long-term impact to them. So that is another point one could make, that volatility and then normalization would be a huge opportunity for stock pickers. Now you're making an assumption then, of course, that there will be that volatility and that normalization. But
yeah,
which was one of my predictions for the year.
Mm-hmm. Is that what you predicted? That there
was higher volatility,
and then it would just basically, that's what I see as the most likely scenario. Yeah. I definitely think that there's gonna be some battles, but I think that ultimately it's gonna be evident that it's not good for anybody, and that's what's gonna trend things more towards something similar to what we have right now, normalization.
And there's certainly a couple in our Canadian small cap area of our research, a couple of Canadian manufacturing companies, really quite good businesses that we're monitoring quite closely. And if there is some headline news that takes down these good businesses that are already trading at lower valuations over the past year, and particularly the past several months because of saber rattling around tariffs, if they come down significantly, which they could, we don't believe that there'll be tariffs long term, 5, 8, 10 years out in these segments. So these businesses, could come on sale. It could be a significant opportunity. Always waiting for to get stake when it comes on sale, and we may get that over the course of this next 3 to 6 months. So we're closely monitoring the markets on that. Now, Brett, you had a couple charts. TD Economics talked about the trade balance. There was a report out from Deutsche Bank that had some interesting impacts on the tariff impact on U.S. inflation. We could take a quick look at those. We'll comment on those, and then we'll get right into the show.
Yeah. So the first one, I think, which really sums up is it shows, I think, really exemplifies where the volatility could come in, because right now you have conflicting policies when it comes to Trump. You have him saying lower inflation, where tariffs will likely increase inflation. This is the Deutsche Bank graph or a chart I have up, where it shows the various amount of pass through of tariffs. So pass through is how much they effectively push through onto the consumer. So if the importer, which pays the tariff, has to pay some of the tariff, they can either absorb it all and not raise prices to the consumer, or they can pass through half, they can pass through 75%. And that's always the question with tariffs, is how much do you actually pass through? And so if they do a 50% pass through, Deutsche Bank thinks there'll be an 80 basis points or 0.8% increase on the consumer price index, the core PCE. So if inflation is going up because of tariffs, does Trump pull back? Does he not? That's really the question here. And then the degree of pass-through as well also varies as well. Is it a sharp? Is it a 75%? Is it 50%? You don't really know until it happens. But just to give you a rough idea, 80 basis points at 50% pass-through. At a 75% pass-through, it's 110 basis points, so 1.1% inflation just off of his own decisions that you could point to. This politician did this. Does that sit well with the electorate? That's where I would really look to, and if you have pullback from there. So I don't know if you guys have any comment on that one.
Yeah, I mean, it would be very interesting to see, how fast some of the electorate would turn on Trump if there was, a significant, because of this tariff, we are now overall paying, 5% more, or 10%, maybe there's even further inflation. It is Nobody wants to pay more, and we've just went through a significant period of inflation. If that were to continue rather than to abate, as we're seeing it abate a bit, I don't think that's going to be a good thing. It's not going to be a good thing generally for Canadians, Americans, anybody. But would that be a good thing for the sitting party and the winds that are flowing around them? I don't think so, and I think maybe the tariff talk pulls back a bit then.
I think that's like a big point that is missed by like a lot of like, some of the, I guess, American rhetoric that I'm like seeing just from Americans, where it's like, yes, Trump is being hard on these countries that have been, screwing us over for all these years. But again, it is going to impact them as well, and I think that point is maybe missed a little bit to some degree, but
yeah, and there's certainly some things
interesting as well the way that
hard
Canada approached it in the last time that we went through this with Trump is that they were actually very strategic about putting tariffs on items that were produced in areas where Trump has actually had net positive support, but like just by a little bit, essentially swing states that went for Trump, Georgia, Pennsylvania, and a few others as well. And that's often thought as one of the things that might have like pressured Trump to make a deal.
Yeah. All right. Do we want to move on to Is that all our charts we're looking at today?
We got one more, which we can do a quick one here. We can do a quick one here just to show like the incongruency between Trump and what he's saying. He has his drill baby drill to lower gas price in the US. And if you are looking to really lower the trade deficit at the same time with specifically Canada, you can actually attribute all the trade deficit and then some to us exporting oil and gas to the US. So there's your ebbs and flows again, where if you're trying to lower gas, can he actually push through tariffs, especially if we were to do some sort of, if he were to do a 25% broad tariff, that would hit the oil and gas as well. So that's another one of those incongruencies.
Yeah, so basically the trade deficit is primarily a result of them buying discounted oil
exactly.
in Canada, discounted oil and gas here, taking it down there, processing it, turning it into higher value product, and then selling it back to us. Right, like it's or selling it into their own markets.
The chart on TD you can see here, the US would actually be at a trade surplus with Canada if you just remove all the energy impact. So that just shows the degree of it. Are we really crazy. The biggest? Yeah.
Perhaps we could refine some here as well. Like that might be something that could be done, but that's been discouraged. So. We'll see if maybe that starts to move forward. I mean, those are huge infrastructure builds that it doesn't, now we're refining this tomorrow. It doesn't happen, but you can point in a different direction potentially. But
last thing, just one more thing. Brett sent over this article as well, and I think that it is important because I am looking at ADF Group as well. But so Canada, this is the headline: Canada, Mexico steelmakers refuse new U.S. orders. So it goes on to say some steelmakers in Canada and Mexico are telling customers that they are refusing new orders to the United States on concerns that President Donald Trump soon will reimpose duties. And Canada's Stelco Holdings has been telling U.S.-based consumers it is pausing sales quotes, according to a person familiar with the matter. Mexico-based steel suppliers also stopped talking orders for materials this week as they are awaiting potential action from Trump, according to Flack Global Metals and a large buyer. So again, it's just interesting. We're seeing, Canada and Mexico continue to try to play hardball here. And, again, I'll be going into a steel fabricator essentially. But how will it impact their businesses?
And yeah, that's really an echo of Trump's first term. In 2018, they did a 25% tariff on steel, 10% on aluminum. And that was pulled back a year later. So do we see that again if there's too much pressure?
I believe that was raw steel, right? Like
correct.
Yes, I think it was raw
not
steel
fabricated,
for that one.
And I'll go into that as well, just in my section.
Okay, good. Well, I'm gonna get to my presentation here. All right, so our Canadian small cap clients should be no stranger to Aritzia. It's been in our Canadian focus buy portfolio since the start of 2020. The stock was recommended at $16.80. Today it trades at $71.78, $8.1 billion market cap. Doesn't pay a yield. They don't pay a dividend, but there's a ton of growth in this business. They keep reinvesting in it and growing. It was founded in 1984 by the Hill family. Aritzia is a long-term growth-oriented, innovative design house and fashion retailer of exclusive brands targeted towards women age 15 to 45, essentially. They do have a menswear area of the business as well. They recently purchased one. But Aritzia operates about 127 stores across Canada and the US, in addition to an established and growing e-commerce platform. So I thought we could take a look at Aritzia's share price over the past year compared to two of the larger names in the Canadian fashion industry, iconic names really. First, Aritzia has performed tremendously well, up over 110% over the past year. The company has significantly outperformed the other two well-known names, Lululemon, as we can see here over the past year, down about 16%, and Canada Goose Holdings down around 6% over the past year. So your question should be, what are powering these strong gains in Aritzia? Well, quite simply, the company's very strong latest quarterly numbers, which bested analyst expectations, strong margin improvement from recent strategic investments and initiatives, and positive growth outlook over the long term. Let's take a look at the Q3 fiscal year 2025 highlights here. Net revenues increased 11.5%, with comparable same-store sales up about 6.6%. These were all powered by tremendous growth in the U.S. net revenues. They were up 23.6%, and they now comprise over 55.4% of net revenue. Gross profit margin increased 430 basis points to 45.8% from 41.5%. Adjusted EBITDA was up 48.7%, and net income increased 71.9% to 63 cents per share from 38 cents per share in the same period of the last year. Now, the strong balance sheet here, net cash position is about $207 million. That excludes leases. Let's look at the guidance going forward, which management raised in the quarter. They raised their fiscal year 2025 guidance due to higher annual revenue outlook, with its midpoint guide increased by about 4% to $2.68 billion. Key margin metrics were unchanged, implying EPS for fiscal 2025 in the range of $1.80 to $1.90. Prior to this, the consensus was about $1.73. They have long-term guidance till fiscal year 2027. Management reiterated this. Their key guidance metrics implies EPS of about $3.50. So that is a significant lift over the next 2 years. Let's look at tariffs. They're always a question in today's market. Let's look at the company's exposure to tariffs. On the most recent earnings call, management spoke to this issue being contemplated by President Trump for goods manufactured in China and sold in the US. The company stated that they have been proactive in diversifying manufacturing base in recent years, with a great majority of its products now being manufactured outside of China. They did convey that they estimate the impact from a 10% tariff would be about 30 basis points to its EBITDA margin prior to implementing any mitigating actions such as offsetting price increases. This should be something that does not significantly impact results, but it is worth monitoring. Additionally, we do note that a weaker Canadian dollar can hurt the Canadian operating margins in the near term. So valuations here, company trades right now about 38.8 times its expected earnings for this year, EPS. And that long-term guidance, if we look out to fiscal year 2027, it's about 20.5 times. Those are definitely premium valuations. Q3 fiscal year 2024 results were very strong in terms of revenue, margin, and EPS growth. This marks the true impact of the company's strategic turnaround and the foundation to capitalize on material growth runway that it has in the U.S. marketplace. That is in place now. The company's solid growth outlook is driven by strong product resonation in Canada and the US, an acceleration of store openings and e-commerce penetration. stronger e-commerce results, combined with cost initiatives, leveraging Aritzia is now positioned for attractive EPS and free cash flow growth going forward. Again, though, the valuations at present are at a premium. That's why we rate the company a hold at present. And there's our disclosures. And I thank you for this.
Yeah, I remember even just like, when there was this decline of consumer confidence and a revision of, Aritzia's guidance downward, essentially, where we were telling clients, like, this is a quality business. It is now trading below, its historical multiples. We believe that these multiples will increase as their earnings come down over the few quarters because they were in, some headwinds. But essentially, it's a good company that we would like to hold, longer term. And
yeah, and we
obviously that
upgraded the
call,
rating then. It was at hold,
exactly.
and we moved it. You could buy half positions, and you were
Exactly.
able to buy them at significantly lower at that point. And I mean, it's as far as the retail landscape in Canada, it's been the pick of the litter for us for the past 5 years. If you look back, it's not just the year performance. You look about 5 years, it's significantly outperformed those names. Incidentally, we're actually looking at a couple other retail names right now. Now, this is Aritzia. We believe in the long-term growth story here, but it's certainly not a combination of growth at a completely reasonable price. It's growth at a premium price right now. We're trying to see some growth at a reasonable price. There's one company we'll look at that we think is a deep discount. Then another company that we're looking to interview over the next week that looks like it has growth at a maybe relatively reasonable price. Again, we'll have to do some more digging on that, but it is a sector we kind of tread lightly in. Retail, fashion can be fickle, but there are a couple names right now that also might get thrown out over the course of this year as they are. If you're just selling clothes or selling retail items in the Canadian market with a lower dollar, that tends to hurt you. So, it may be a time to pick up some of those names depressed if it is a good quality business and they've got some growth ahead of them. So we're looking at a couple names now.
Yeah, and you can really see in just on your Canadian dollar point, just the difference between the Canadian and US growth for Aritzia. Like they've done more openings in the US, but it's what, 23, 24% in the US, 5% in Canada for their revenue growth. It's just the consumer difference is just massive right now between
their same store sales growth is bigger there too, but obviously they've opened more stores. But it's a better consumer environment in the US than it is in Canada. You can see this on this company. Again, the fact that they're able to grow right now, we're seeing a lot of names not grow in the Canadian market. It really talks about the execution from management and that margin increase that we saw. The new fulfillment center that they opened up, they got a new a back end system that they put into place. Plus, they're just managing the business quite well. New styles that resonate. It's so hard. It's such a hard business. You've always got to stay ahead and on trend, and that's something that they've been able to master. It's very difficult to do. Like you can have a Gap, and people can say, "I hate the Gap now," and Gap could be producing the same clothes, and that Aritzia has really stayed out of that fray of in out. I think it's they don't just have Aritzia on their brands. They have certain brands within the store that kind of maybe those ebb and flow in terms of sales, and then they create a new brand under the Aritzia or a line under the Aritzia brand. And it's really been successful over the long term. Quality clothes at a semi-premium price. It seems like a good model. And they don't close any stores. All these other retailers that we look at close stores. You're always looking at how many stores you're opening and then versus how many you close to see if you can inch ahead. The only thing they do is refresh stores, and they're just launching new stores, and they're not doing it at such a pace that you're getting ahead of yourself on your skis. They're doing it at a measured pace over time, so they make sure these stores are very profitable. I mean, it's been paying off, and the company is now getting a premium multiple. Again, that is a high multiple you're paying for a retail company, so you got to be wary of that right now. Tremendous gains. It's right now we have a hold rating on the stock. So, all right, I think that's beating that not dead horse, right? We're beating that horse. Aaron,
Yeah.
you watched Lemony Snicket's, right?
Yes.
Didn't you say you did? Yeah. Do
Well,
you
my
know that when
kids
they, yeah. Well,
love
when I hear that
really
dead
enjoy
horse,
coordinated
remember they had
events.
that
Yeah.
university with the beating the dead horse, or the school,
I
yeah.
haven't seen all of them, but
Okay,
it
because
is the most depressing show.
it
But my
is.
kids just love it.
It's
They've
hilarious.
watched it over and over. But it's good
Neil,
because it's about problem solving and dealing with
yeah,
adversity, and so that's great. Very different, but yeah,
Doogie
really
Howser,
depressing.
Neil Patrick
Nothing good.
Harris. He's good in it.
He's great.
Anyway, see you later. All right, let's move on. Aaron, you're looking at the headline news of the day, right?
Yeah,
It's there's this
really interesting.
a new Chinese AI competitor. Probably not
There's
really new, but just new to
there,
our ears.
I mean, to an extent, everything's new in that space, but
Mhm.
they've been around. They've been around for a couple of years, but really just in the last couple of weeks, they've really created a stir in the whole AI market, and this accelerated today. So there are a lot of news stories out there talking about this, but tech stocks are down today due to this Chinese startup and their AI model. NVDA down 17%, I think actually 18%. So big news in terms of the AI industry, but also impacting stocks. Broadcom as well, Microsoft, Google down, the NASDAQ down about 3%, at least the last time that I looked. So what's going on here? I think this is really interesting. It's not one of the typical purely finance or stock related topics, but it is certainly impacting the investment industry and the stock market. So it's worth taking a look at. So this startup that we're talking about here is called Deepseek. They recently released their newest upgraded model, and what I can say is that the AI arms race is heating up. So what is Deepseek? Well, Deepseek, they were established in 2023, headquartered in China, and they are rapidly emerging as a significant player in the AI space. And there are some deep implications there that I'm gonna talk about. Mostly positive in my perspective, but in terms of rapid progression, so in May of 2024, they released their DeepSeek V2 model. This was noted for its cost effectiveness compared to the other frontier models of the top companies at the time. But just recently in December, they released their V3, 670 billion parameter model. So this is a large model, but it was trained at a fraction of the cost of what we're seeing OpenAI and Anthropic and Google train their models for. So just under $6 million to train this massive model, which is really pennies compared to what the other players are paying to train theirs. So this is really a game changer in AI for many reasons. So let's just take a look at DeepSeek and kind of what it offers that a lot of these other major players aren't offering. Well, one, it is completely open source. It's under an MIT license, so anybody can download the weights, download the model. You can modify it. You can use it for your own purposes. 100% free. That's a fairly permissive license in terms of doing what you need to do with it. Of course, this is a 670 billion parameter model, so not many people are going to be able to run that on their own machine. But it also provides user-friendly access. So in addition to being able to access the open source model, you can also access it through a UI chatbot similar to ChatGPT or an API, which will allow developers to access the model hosted for them, pay a fee for that, and then integrate it into their applications. It's an extremely cost-effective solution. So this is really, in many ways, where it's groundbreaking, cost-effective to train, but also cost-effective to purchase access to as a developer as well. And in spite of this, the performance is quite high, so comparable with the top frontier models right now of the day. So I'm just going to do a little model comparison here, and I'm going to compare DeepSeek's R1 model to OpenAI's O1, which is essentially considered the frontier model, the top model right now. Competition in this space has just absolutely gone crazy over the last year and a half. OpenAI for the first couple of years really had what seemed to be an insurmountable lead over everybody else. But over the last year especially, other competitors have caught up. The open source community as well has come up with models which are comparable. Deepseek now being the top one, I believe, in that space. Meta with their Llama 3 model. But OpenAI's O1 still takes the lead in terms of the frontier model on most tasks. So this is where we're going to compare it. So this is a closed source model that is owned by OpenAI. You cannot download it. You cannot modify it. You can fine tune it through them. And then you pay for API access, or you can access it through ChatGPT. In terms of the model size, that's unknown. It's not something that's disclosed. It's likely that it is actually consists of multiple models, which together have at least a couple trillion parameters, massive in size. And the training cost. So this is also information which is not necessarily public, but some of the estimates that I saw put it at about $6 billion. I would say probably at least that or more. Now let's compare it to Deepseek. So this is open source. That means it's completely open. You can developers, computer scientists, AI engineers can go in, see the weight, see how the model works, download it, modify it, use it, or access it through the API. Model size, as I said, 670 billion parameters. This along with Meta's Llama 3, which I believe is 700 billion parameters, is the largest open source model. And then the training cost, 5.6 million. So comparing that training cost to what OpenAI and the other large players are paying to train their models, this really shows a transition in the industry. I mean, if somebody who this originally is I understand it, this was a side project and not funded with the original models. But if you're able to train a model for only a few $1 million that is comparable to some of these massive models, it really shows that there's not much of a moat that OpenAI or some of these other model companies have, which may be the reason why companies like Meta also chose the open source model, because their Llama 3 is also open source. Now let's look at a model performance comparison. So again, we're comparing this to O1. There are benchmarks, testing benchmarks, which are used to evaluate and compare the different models. So one being mathematical reasoning, they were about equal on that. General knowledge, OpenAI's O1 outperformed it just slightly. And then for software engineering tasks, Deepseek actually outperformed just slightly. So really kind of comparable performance here, which is extremely impressive, given the other things that I mentioned, the open source nature and the low training cost. But let's take a look at price. So if you're a developer and you want to integrate the state of the art models into your applications, you would access the API. So all these companies offer API access, and you pay per million tokens. So a token is basically, it's almost like saying a word, a little bit different. But 1 million tokens would probably be about 700,000 words going through the model, input and output. So for OpenAI, the cost for input and output tokens, $15 per million input, 60 per million output. We don't need to get into the explanation of the difference, but these are the costs. Now look at Deepseek's costs, 14 cents per million input, 28 cents per million output, a fraction of the cost to access it, which makes sense given they spent a fraction of the cost to train it. So this is pretty incredible. It's disruptive to the market, not just necessarily in terms of what Deepseek has done, but in terms of who else is going to come out just out of the woodwork all of a sudden and produce a model which is on par or better than the top closed source models, but at a fraction of the cost. So this is very interesting. But what does it all mean for investors? Well, we've seen what it means today, and that's market volatility. So NVIDIA shares down nearly 18%. Broadcom, leading semiconductor company, experienced a decline today, 15%. Microsoft and Alphabet both down today. The NASDAQ down about 3% as of the last time I looked. So right now, it's about kind of digesting the information and understanding what it means. And often, we get these reactions. But I think that, mid to long term, what people need to realize is that more competition in this space is good. I don't want to see all of this technology concentrated into one company or even one country necessarily. So having all of this competition out there is generally a good thing to provide access. The reason why is because if you have the top model and it's capable of doing so much more than all the other models, and you control who is able to access it and use it, you essentially are in a position to pick the winners and losers. But if there's a lot of competition, people have choices. So I like that. I think it's more competition. It's more investment then that is going to come into the industry now. I'm comparing this with OpenAI's O1 model, but OpenAI is actually already in the process of launching their O3 model. So we'll see then how this is going to compare to that. But as more better models come out, other companies invest more, the open source community invests more, and every once in a while, somebody comes out of nowhere and just innovates and does something that is amazing to the market. You know, another thing that people are looking at here is just how this impacts the dominance of Silicon Valley, because there's a saying in the technology space or in Silicon Valley, and that's that the US innovates, China imitates, and Europe regulates with respect to technological innovation. But this is not an imitation, or at least from my understanding, this is actually a big step forward that we're seeing from a rather small company in China. That I don't think it's not like they necessarily had a huge amount of financial backing to accomplish this. So I'm sure they will have a lot of financial backing now, and it'll be interesting to see how this all turns out.
It's a little high level for myself.
Or was it too high level?
Well, no, it's not high. It's not too high level at all. No, it was good. I just don't know what to say
Summary is
about
what
it.
you're saying. Good summary of the events.
I mean,
No, it
I
is
think
interesting. I think
the
that
point is that, like, I've been doing a lot of, we've all been doing a lot of thinking about. We're not trend investors, but we also like to. We know that, like, in some cases, trends exist in areas that there's a lot of capital flowing into, and there's a lot of reason why innovation needs to occur. So you want to know where the trends are, and of course, the biggest trend, and nobody needs to be told that right now, is AI. But the question is, what inning are we at? I mean, are we in the later stages now, where we're basically going to start to see more of an AI winter and a downturn, or are we still in the early stages where people need to look for opportunities? That's a question we like to answer. But then, of course, you need to know the specific opportunities, because whenever you have a market where there's a lot of excitement, you are also going to get a lot of very promotional companies that arise in that area just to raise money that you don't want to invest in. So it's also about finding the difference between those.
Yeah, I think thinking one of the more interesting things you talked about was for me, it was thinking of China as more of an innovator versus just copying. I mean, that would be a significant shift versus the U.S. Silicon Valley, which has always been at the head of innovation, and that would be a significant difference. On like the drops that you saw today, the other thing is I'm not sure if everybody wrapped their head around how impactful this development can be, if it really is. I mean, I've read articles on it potentially, that this is one model that can answer certain questions, but does it have the infrastructure? Does it continue to be able to answer those questions going forward? Is it just answering at one set point in time, and can it like learn going forward? I'm not sure. Like this is not my area, but the other thing I'd say is the drops we saw today. I think we were talking about part of it is you have companies trading at premium multiples, and sometimes the market wants to have an excuse to shave some valuation off of these names that are just trading it. I mean, we went over in the last couple of podcasts where North American markets are on a relative valuation basis historically, and we're at significantly on the highest end of valuations that you've seen in 25 years essentially. So it's not surprising to see the market jittery and have a pullback on something that maybe this is impactful, maybe it isn't. But there's companies in other sectors that really have nothing to do with this segment that I track in portfolios that dropped off 5% in this day, and this will have no impact to their business. But they were trading at premium multiples, and you see a bit of a risk off in that environment, and there should be, I think there should be some trimming of multiples. And if this is the excuse to do that, potentially, maybe that's what happens over the next month or and we get some companies that we would like to buy come into some more reasonable ranges, and we get to buy them potentially. So we'll look out for that.
Yeah, and just on the size of the pullback, because you're mentioning the premium valuations, how it pushed up the market valuations last year. NVIDIA on its own represented something like 7% of the S&P 500 gains for 2024.
Yeah, crazy.
And just to give a size of the pullback for NVIDIA, it was $589 billion today. And OpenAI's total valuation for the last round of raising was $157 billion. So NVIDIA lost 4 times the valuation for OpenAI just today. Just to give a size.
I would think that
Absurd.
The whole idea that this is going to be bad for NVIDIA, I mean, more AI and better AI means you need more powerful GPUs and infrastructure, which is you might argue that then this is an opportunity for NVIDIA. I think if OpenAI were publicly traded on the stock market, they'd be down 30% today, to be honest. And then they would probably recover maybe after they release their O3. But yeah, I just think that it looks like the competition, if anything, and the technology is just heating up and accelerating.
And yeah. I guess the results, I guess it's open source, so everything's been peer reviewed that's come out of here. Like, we know that this is actually what happened. I'm not that I'm saying anything, but it's come out of China, and there have been in the past things that are not framed in a positive light that actually aren't as impressive.
Yeah, so that's a good point. And yeah, so because it's open source, you should be able to, like, people at this point have taken it and tested it themselves, and it should be. But I mean, I haven't done that myself, and I haven't gone through and researched all the results of that. I'm really just reporting what's happening out there. Yeah. It's definitely.
I mean, it is open source. It should be testable. So, I mean, we'll find out probably
again,
over the next week.
Not everybody can test a 670 billion parameter model, but some people can, and organizations can.
Brennan tests it in his sleep. Let's be honest.
On his laptop.
Right? All the time. I was also going to just say that power companies were also down. Just like CNBC here. Here's an article: power companies that are most exposed to the tech sector's data center boom plunged Monday, which is today, as the debut of China's Deepseek open source AI laboratory led investors to question how much energy artificial intelligence applications will actually consume. Vistra was down 30% today. Constellation, Talon Energy, GE, Vernova, all down 20%. So again, it's just kind of,
I think that this doesn't really make a lot of sense to me. And I mean, I'm not going to say that that's opening up a buying opportunity, because again, as Ryan said, a lot of these companies really had to come down anyways.
Yeah.
A couple of those names I think were already highly valued. So maybe now they're at a point where it's fair value or closer to. But again, it's the need for power and data centers doesn't go down because you get superior models. I mean, you could say, well, you could do the same with less computation, but you're not. You're going to just do more with the bigger models. So it's, yeah.
Good point.
All right, let's move on. Brett he's got a Your Stock R take this week, and you're doing it on Dirtt, DRT. Environmental systems company, engineering company, or construction business.
So it's an interior design. It's like those prefabricated walls, which you can put in, like they're semi-permanent for an office space, but you can put them in it with more ease. That's effectively what they are. You've probably seen in office or hospitals or anything like that. You'll know it when you see it. So Dirtt Environmental Solutions, is symbol DRT on the TSX, is a modular interior construction company that specializes in sustainable building solutions. In addition to prefabricated physical products like their walls and their doors, the company also offers its proprietary design integration software, or ICE, which helps people design their offices and build out with their products. The company operates in both the US and Canada, with the US being the lion's share of the revenue. The stock is trading at $1.18 a share and a $228 million market cap after a very strong performance over the last year, rising 107%. However, when we step back a bit, zooming out on the stock performance is just not being very good. You can see it's come up over the past year, but the stock is still trading very well off its all-time high set in 2019, and that was about $7.60. So you're looking at really a seventh of where they were 6-7 years ago. So why has the stock really performed so well over the past round? Is a turnaround now occurring in the company? So just pulling up a chart from the company's Q3 presentation, as it really shows the really major shift which they've seen over the past couple of years, and that's to do with gross margins. Gross margins have improved dramatically, with non-GAAP gross margins up at 40.7%, and that is all the way from 17.7% in Q1 2022. This is now similar to the 2019 levels at that 40%-ish level, and it was prior to 2019, it was in a similar mark as well. The improvement was largely driven by cost reduction measures that the company has taken over the past couple of years. The company closed a couple of facilities as well as lowered its headcount quite a bit, by about a quarter from 2019 to 2023. This has really reflected across the business as a whole, and it has overall really pushed the company towards overall profitability, with the last quarter marking 4 consecutive quarters of GAAP profitability, but that does have a caveat in it, which I'll go into in a couple minutes. So moving on to the most recent financials for Q3 2024, the figures are in US dollars, even though it is trading on the TSX, the financials are in US dollars. So revenue fell by 12% year over year to $43.4 million due to 4 large projects occurring in Q3 2023 that did not reoccur. So it had a bit of an uptick last year, so it fell off this year. But overall, if you take those out, it's round flat. GAAP gross profit margin improved to 38% from 34.4%, but gross profit overall on a nominal basis fell slightly to $16.8 million from $17.1 million due to the lower revenue level, so improved margin but lower revenue base. Adjusted EBITDA fell to $4.1 million from $5.3 million, as the EBITDA margin did fall to 9.4% from 10.6%. Due to that lower gross profit as well as higher operating expenses. So the company as a whole had reduced operating leverage on that lower revenue level, despite the improvements in those gross margins. So net income, however, did come in at $7.1 million or 3 cents per share, a big improvement from a loss of $6.3 million or a loss of 5 cents per share. This is really due, however, due to a gain on extinguishment of convertible debt, as Dirtt did buy back $32.5 million of face value of debentures during the quarter. Without the gain, the company would have been at a slight net loss, which does really take away from that consecutive GAAP profitability I mentioned before. But still, it's a big improvement, even if you do take away that extinguishment on debt. So shifting to the balance sheet, the company had a net debt position, including leases, of $31.7 million. Without the leases, Dirtt is at a ever so slight net position, but nothing meaningful, so effectively zero net debt. The level of net debt has been significantly reduced over the past years. The company repurchased outstanding debentures at the start of 2024. This was, however, they funded at the start of the year, and they just recently bought them back during the quarter. And they funded this through a rights offering and issued shares, which were then converted at 35 cents a share. So the balance sheet improved a lot at the cost of increasing share count by about 62%. So big increase in share count, but it vastly improved their balance sheet. That's your trade-off there, shifting from raising through debt to raising through equity. The trailing net debt and leases to EBITDA is at now 2.2 times, which is on the higher end, but that's effectively driven by the leases, as I said before. And it does seem now to be structurally sound, at least after repurchasing those debentures. I would say that's a bit high, but since it is in leases, and the debentures are actually only at 6.5%, which is cheaper than what you'd expect a company in distress. Some of those companies we see in distress, when they're really leveraged up, that was at 13, 14, 15%. So the interest rate isn't excessive on what they're holding them at. Additionally, off the balance sheet, the company does have significant tax loss carryforwards in both the US and Canada, so the company will unlikely to be making actual cash tax payment in the coming years, which is a benefit when you do see these turnaround stories, as it gives them a bit more growth leeway. They can reinvest the capital at a higher rate because you're effectively saving 20% or so of cash because you aren't paying that cash tax. So looking forward for 2024, so that's just one quarter left, the company is guiding $165 million to $175 million revenue and $12 to $15 million in adjusted EBITDA, but they actually have guidance for 2025. The company is guiding $194 to $209 million revenue and $18 to $25 million in adjusted EBITDA. Off those midpoints, 2025 revenue is expected to grow by 18.5% and adjusted EBITDA by 59%. So big uptick in that adjusted EBITDA because you are once you get that revenue up, if they are able to keep the margins, you do start to get that economies of scale and it hits that bottom line. As well, Dirt's 12-month pipeline at the end of Q3 sits at 255 million, which is slightly lower than the previous year, but they have said that they have a higher quality within their pipeline. And you may notice, why is their revenue guidance lower than their pipeline? Is because it's just quality leads. And this is why you always want to examine their pipeline or backlog, whatever the company may call it, because there can be differences in what they're actually expecting. Some will be firm contracts, and in this case, it's just leads. So on a valuation basis, using the company's guided midpoint EBITDA for 2025, the EV to adjusted EBITDA is at about 9 times, so not overtly cheap nor absurdly expensive at the current levels, given it is a recovery story at the current time. But it may have upside if you are able to execute, if you are able to hit those targets, keep the margins, grow the revenue. You do have some room for upside. But then on the flip side, if you do see a reversal, which you do see in some of these recovery stories, it's not all green pastures once you get out of the really trenches. You do have some downside risk, to say the least. So concluding, Dirtt really has had a rough couple of years, but rebounded in 2024. The company restructured its balance sheet, making the debt level manageable. The margins have recovered, but now we really need to see, can they grow from top to bottom line to support any really appreciation in the stock. To do this, the company will even need to navigate the risks just that come along with the construction industry as a whole, including the cyclical nature of the material inflation, which really hurt them last time, as well as just the overall supply chain management, which could have elevated risk given the current tariff talks. Overall, though, we will continue to monitor the stock as it really needs to just execute on its targets. It needs to be able to pass through this transformation, but it does look like it's at least making good headway, and it's now a question of whether or not they can continue into a now growth story.
Yeah, I think it's a good summary. I think, I think it is, getting more interesting on the margin improvement. I guess it's always what when you're looking at investing, it's, you look at this company, but then you look at 10 or 20, 30, 50 other companies. And like over the course of this past year, we were able to invest in some companies that had a growing backlog, like record backlog growing, and a projection of growing that going forward, traded at these valuations or lower, significantly lower on a current trailing EPS basis. And again, had more certainty to their growth. It wasn't a pipeline, it was a more firm backlog. So, there is some things to like about what DRT is doing right now, but you're always comparing that to what are your other opportunities out there. And if you have more certainty in a backlog versus a pipeline, and it is growing and you're trading at lower multiples, I'm going to go with that company versus this company. So this is a company we monitor. If it flips to where we see a firm backlog and growth in that, and then, trading it relative to reasonable valuations, perhaps at that point it can become a buy. But again, one of the companies we monitor, at some point over the next 6 months, 6 years, that may become a company we could buy for clients. It's not there today.
Yeah, and I think that's something which a lot of people just overlook in general, is the downside risk. Because when it doesn't happen, you just make out like a genius, even if you were investing it, but you could be taking on more risk than what you really took. And then we get that a lot, saying when you see with some of these speculative companies, when they go up, not saying even Dirt's even overly speculative, but speculative companies in general go up, whatever, 100, 200%. And then it's just the risk didn't occur. And sometimes it still even exists. But you'll have people point out you are wrong, not recommending this, when there's that risk there, you just didn't have it occur.
Yeah, and if you're putting 10 of those type of companies, when you have too much risk and it has to hit on all the targets that they're speculating on growing at that level over this period, then I'd rather have a company that has a firm, I mean, it's hard to find, but you can have a firm backlog, low current multiples, growth outlook, good balance sheet. Like, you can have all those things. It's probably one or two out of the 1,000 companies that you look at, but look at 1,000 and find those companies, and you're going to push aside many companies that have a good story, but they might not have most of the items you want to check off. That is a way to prevent having catastrophic errors in your portfolio. So, I mean, that's what we're looking at. All right. I think that ends that segment. Let's look at Brennan. He has got a your stock, our take on ADF Group, right?
So yes, this is a Your Stock Our Take. This came in from Mario via email. We actually got a lot of these questions on ADF Group. But Mario says, "Good afternoon. It is always a pleasure to listen to your podcast on my commute home." Thank you for that. And he says, "My question is on the small cap DRX. I bought a substantial amount in 2022 and became about 20% of my portfolio as of the beginning of 2024. Then the price went down, but I couldn't find any major reason for it and bought more at the end of 2024. I believe in holding stocks for the long run and let the winners go. It continues to lose momentum so far. I would appreciate your opinion." So here is my opinion here for you, Mario. So again, this is ADF Group Inc. or DRX on the TSX, currently trading at a price of about $8.90 with about $160 million market cap and about a 0.4% dividend yield. So ADF Group is a North American leader in the design and engineering of connections, fabrication, including the application of industrial coatings and installation of complex steel structures for the non-residential infrastructure sector. And as of Q3 2025, management noted that its Canadian facility in Montreal is at about 70 to 75% of capacity, and its US facility in Great Falls is at about 65 to 70% capacity. And the fabrication shop in Canada can do approximately 100 to 120 tons per year, while the US fabrication shop produces approximately 25 to 35 tons per year. So most of the fabrication tonnage is coming from Canada. So the stock has had a strong run since the beginning of 2023, up about 330%, driven by strong financial results. And as Mario indicated, the stock has since become a large weighting in his portfolio due to the gains. So, I will say congrats on the gains there, Mario. Now, the last time we covered the stock on the podcast was in October of 2024. Brett covered the stock on the podcast at that time, and really I'm going to be parroting a lot of what he said then. But we also actually wrote up a monitor report for clients in our most recent Canadian cash-rich profitable small cap research report released in late December. Now, looking at the recent quarter of Q3 2025 ended October 31st of 2024, revenue was down about 3% to 80 million from 82.1 million in Q3 of 2024. Gross margin for Q3 of 2025 was 30.4% compared to 24.4% for the same period in 2024. Now, the improvement in margins is largely attributable to a better absorption of fixed costs in line with the increase in fabrication volume, the continued favorable impact of the investments in automation at ADF's plant in Canada. So they have been making automation investments there, and a favorable mix of projects. In fact, since the beginning of the current fiscal year, the mix of products in fabrication was particularly favorable given the increase in automated fabrication, which is higher margin. Now, adjusted EBITDA was 24 million or 30% margin, up 35% from the same period in 2024. And net income rose to 16.4 million or about 55 cents per share, up 47% from a gain of 11.2 million or 34 cents per share for the same period last year. And the balance sheet is in a net cash position of about 19.1 million. And this equates to a net cash per share balance of approximately 64 cents per share. So let's look a little longer term at how the business has performed. So year to date, we have seen record margins with gross margin of 32% and net margin of 18%. But keep in mind, ADF Group is a contract-driven business. And over the long run, margins have been cyclical, which management equates the recent margin expansion to about a third coming from the automation investments coming online at its Canadian facility, about a third absorption of fixed costs given the higher volume, and as well last year, about a third from project pricing benefits. So margins are certainly at a historical high right now compared to the past decade. Now, ADF Group's order backlog totaled about 330 million, compared with 339 million on the same date a year earlier, and about 510.9 million on January 31st of 2024. Now, on average, management says that backlog is comprised of about 45 to 50% of fabrication hours, 35 to 40% for installation, and the balance is for raw materials, about 10 to 20%. And the reason I'm bringing this up is just to show that the backlog is not super sensitive to the price of steel. Now, the company does not provide guidance, but it is of management's opinion that they still see 3 to 4 years left of growth in what they're claiming an atypical business cycle. They also voiced that margins were heightened in fiscal year 2025 and will likely come down in fiscal year 2026. Now, growth in revenue is anticipated, but gross margin dollars are expected to remain flat year over year, given the margin or gross margin headwinds. Now, since the company became profitable in fiscal year of 2021, you can see on the graph here that I have up on the screen or the table, the company has maintained an average price to earnings multiple of approximately 6 times. And now looking at the current trailing valuations, ADF is trading at about 4.6 times trailing accounting earnings, which, like I just noted, is below its 5-year average of 6 times. And the company trades with an enterprise value to EBITDA multiple of about 2.8 times and a price to cash flow multiple of about 3.1 times. So, relatively speaking, the company looks cheap, or at least appears cheap. And here, I just essentially wanted to show this up on the screen, or tease that, for clients, I actually went through a scenario for fiscal year 2026. So I actually hypothesized an expected growth rate in revenue and a net income margin to provide clients with what we believe fair value to be if the stock can continue to trade at its average PE multiple of 6 times. But obviously, this is exclusive to clients in that report, which was released in December. So to conclude on ADF Group here, ADF Group has performed well over the past 5 years, growing backlog to $330 million in fiscal year 2025 from about $200 million in fiscal year 2019. And it also expanded gross and net margins from about 8% and negative 0.5% respectively to about 24% and 11% in fiscal year 2024. Now, over fiscal year 2025, the year-to-date period, gross and net margins have expanded even further to 32% and 18% respectively, driven by better absorption of fixed costs, and of course, increase in fabrication volume, the continued favorable impact of investments in automation at ADF's plant in Canada, and again, favorable mix of projects given the increase in automated fabrication at its Canadian facility, which is higher margin. Now, cyclically, ADF is exposed to the non-residential construction industry with a typical business cycle lasting, 5 to 6 years, followed by a couple years of slowdown. And during an upcycle, ADF's margins have typically performed well. Now, management indicates strength in demand persists with further upside to the current cycle, driven by infrastructure spending in the U.S., lower interest rates, and reshoring of manufacturing. But looking forward to fiscal year 2026, margins are expected to come down given the favorable factors experienced in fiscal year 2025. And on top of the cyclical risk, a majority of ADF's revenue comes from the US. This is actually above 85%. Therefore, US and Canadian trade relations, such as tariffs imposed on Canadian goods, can impact the company's demand and profit margins, with, of course, President-elect Trump threatening, a 25% tariff across all Canadian goods when he takes office here. This could materially impact ADF's operations as it ships fabricated steel products to the U.S. from its Canadian facility. Now, management believes that potential steel tariffs will likely focus on raw imported steel rather than fabricated steel imports. So that's something that's good to note. And even Ryan mentioned that in the introduction of the podcast as well, just to make sure that we're pointing that out. But, there does remain risk that potential steel tariffs could materially impact the business. And in the near term, management is seeing some downward pressure on pricing and slower project decision-making as clients wait for more clarity. So in the near term, the business does not need capital for, expanding capacity, and will likely focus on paying down debt and returning capital to shareholders, which is great. And, all in all, my long rambling here There is an investment case for ADF as it possesses a healthy balance sheet. Backlog remains elevated and the business remains relatively cheap in relation to its earnings and adjusted EBITDA. However, risk is heightened in the face of near-term, tariff uncertainties, as well as tough comparable margins the business will need to lap in fiscal year 2026, and the risk of potentially investing in the later stages of what management has called, an atypical cycle. And as such, we continue to monitor. And then I'll also just show the disclosure here that we do not hold positions in the stock.
Yeah, I think it's a really good summary. We put together a good report. I think management, when we interviewed them, they were competent. I think, I think it's
Agreed.
a pretty well-run business, but it is a cyclical business. And, we did talk to the company, about their contracts going forward. And, you want to monitor that backlog. Are they going to have to take on, some lesser margin businesses? Because, the margins are not where they have been historically. Yeah. So there's the risk that you even come through with relatively similar revenues, but at lower margins, or lesser revenues and same margins, then it's going to be hard for them to have growth on the bottom line over the course of the next year. It looks like it's relatively cheap, but then you look back at a historic PE on the company, and it always trades at a discount because of the cyclicality of the industry. Perhaps we have a longer term cycle there that continues, but I always hear it's different this time, and it doesn't tend to be different this time. So you've got to take, not from management that I'm saying, but you've got to look at it in the light of a company that has been cyclical long term, and those things typically don't change over the long term. So we would just monitor the business at this point, despite the fact that if you compared it to a market PE, it looks cheap.
Yeah.
But is it in terms of a company that has a significant amount of cyclicality and is trading with, inflated margins, really? Or like, these are high margins for a business like this, and this business, if you look at it historically.
Yeah, exactly. Like, and if we look, I did have it up on the screen, but if we look back, at the last 11 years, 2015, 2018, 2019, 2020, all negative net income margins. In those years, even just, 2016 and 2017, it was marginal net income margins of, 2%. So all of a sudden, in the last 9 months, we're sitting at 18%. Obviously some of that automation has helped, as management indicated, and I noted, but.
Yeah, and there is the potential to sustain a higher level of margins over the long term. And we're not saying it's going to go back to significant negative margins, but, you've seen a tremendously good environment for the company. Yep. Does that continue going forward? Well, for you to grow earnings next year, like we will have to, and I'll bring that back to, we do see businesses where you have a finite amount of capital that you can invest. If you can find a business that does look like it has growth next year, has a good balance sheet, trades at a reasonable price, that's what we're looking for. This company checks off a lot of those boxes. Yep. We're not looking at EPS growth from our estimations this year. And if we don't see that, we'll just sit on the sidelines and wait till we are projecting growth, or we see management projecting earnings growth going forward, because that's going to drive the stock ultimately. Even if it looks cheap now, you want to have growth in the business. And that's why we have a GARP approach. If you don't have the G in GARP, you have ARP, and I'm not sure what that is. That doesn't make sense to me.
Nice.
So we're going for GARP, not ARP.
Yeah.
I think that's going to close our show off for this week. If you're watching us on YouTube right now, viewing us, smash that subscribe button. If you are listening to us wherever you consume your podcasts, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.